There is a silent partner in your retirement savings, and it is the IRS. It owns a piece of nearly every dollar sitting in a traditional retirement account, and sooner or later, it comes to collect. It forces money out, it taxes what comes out, and it lets that ripple into your Social Security and your Medicare on the way. You may already know that part. What almost no one ever shows you is the other half of the story. There are a handful of places you can put your money where that partner legally cannot follow it. Accounts the IRS cannot tax the way it taxes everything else, and in most cases cannot force you to touch at all. Move your money into them, and every dollar you shift becomes a dollar the tax man loses his claim on for good. Leave it where it sits, and you are simply holding that money for him until the day he comes to take his share. So this really comes down to one question. Which side of that line is your money on? And the window to move it to the safe side is smaller than almost anyone realizes. So before that partner starts collecting, here is exactly where your money is beyond his reach and how to get it there in time. Start with the difference that everything else rests on, because most people get it exactly backwards. There is a world of difference between money that is tax-deferred and money that is tax-free. A traditional retirement account is only tax-deferred. It is not yours free and clear. It is an IOU written to the government, and every dollar inside it still has the taxman's name faintly stamped on it. The accounts you are about to hear about are different. They are tax-free. Once your money is inside them, it is fully, finally yours, and the growth on top of it is yours too. That single distinction is the whole game. Here is how to feel the difference. Two neighbors each have $500,000 saved for retirement. One holds it in a traditional account, the other in a Roth. On paper, they look identical, equally comfortable, equally safe, but they are not equal at all. One of them truly has $500,000. The other has $500,000 minus whatever the government decides to charge on every dollar pulled out for the rest of their life, at rates no one has even set yet. Same balance on the screen, two completely different fortunes. The only thing that separated them was which account they chose to hold it in. So here are the 5 places the IRS cannot touch your money the way it touches everything else. The first is the Roth IRA, and it is the cornerstone of the entire strategy. You put money in after you have already paid the tax on it, and from that moment forward, the account grows completely tax-free, and qualified withdrawals in retirement are completely tax-free. There is no forced withdrawal, not at any age, ever, for the rest of your life. The government collects its tax once, on the way in, and then it never touches that money or a dollar of its growth again. It cannot make you pull from it, and it cannot tax what you choose to pull. Every dollar you move into a Roth is a dollar you have quietly walked out of the partner's reach for good. And think about what that does over time. A sum you move in during your 60s can double or more by the time you are in your 80s. And the entire gain, every dollar of that growth, is untouchable. The government taxed the seed once and then gave up any claim to the tree. That is why the earlier a dollar lands in a Roth, the more powerful it becomes. Because it is the years of growth, not the deposit itself, that the taxman is permanently locked out of. The second is the Roth version of a workplace plan, the Roth 401k. It works on the same principle, tax-free growth and tax-free qualified withdrawals. And thanks to a recent change in the law, it no longer carries any forced withdrawal during your lifetime either. For anyone still working or holding one from an old job, it is a large shelter the government simply cannot pry open on a timetable. And unlike a Roth IRA, there is no income limit blocking the door on the way in, which makes it a quiet workhorse for people who earn too much to contribute to a Roth directly. The third is the one almost no one uses correctly, the health savings account. It is the only account in the entire tax code with what is called a triple tax advantage. The money goes in tax-free, it grows tax-free, and it comes out tax-free when it is used for medical costs. 3 separate tax breaks stacked on one account, and nothing else in the law does that. Here is the mistake that wastes it. Most people treat a health savings account like a checking account, spending every dollar the moment it goes in. But if you can pay smaller medical bills out of pocket and leave that account alone to grow for years, it becomes a stealth retirement fund that the IRS never taxes. Because in retirement, your medical costs are almost guaranteed to be large. Even better, once you reach 65, you can pull money out for any reason at all, paying only ordinary tax on non-medical use, which puts it on the same footing as a traditional account at worst, and leaves it completely tax-free for the medical spending that is coming no matter what. There is an even sharper way to use it that almost no one knows. When you pay a medical bill out of your own pocket, Keep the receipt and leave the account alone to keep growing. Years later, you are allowed to reimburse yourself for those old bills, tax-free, pulling out money that has grown for a decade to cover a receipt from long ago. It turns the account into a tax-free bank you can open whenever you choose, on your terms, and never the government's. The fourth is municipal bonds. When a state or a city borrows money, the interest it pays you is exempt from federal income tax. That is income landing in your pocket that the IRS does not get to tax the way it taxes the interest from an ordinary account or a bank. For someone sitting on a pile of cash that is throwing off taxable interest and quietly inflating their tax bill, moving a portion into municipal bonds can turn taxable income into income the government cannot reach. And if you buy bonds issued by your own state, the interest is often free from your state tax as well, stacking a second exemption on top of the first. It is a tool built for people past their working years, sitting on cash or taxable holdings, who want steady income without feeding the very tax bill they are trying to shrink. One honest caution, so you are never blindsided. That tax-free interest still counts in the background formula that decides how much of your Social Security gets taxed. So it is a genuine shield against one tax, not a magic cloak against every one of them. Used with open eyes, though, it is real income the taxman does not touch. The fifth is permanent life insurance, and this is the one to walk into slowly, with the most caution of all. Inside a properly built policy, the cash value grows year after year without being taxed. You can often borrow against that cash value without triggering a tax bill. And when you die, the death benefit passes to the people you love, completely free of income tax. It is money that grows in a place the taxman does not get to open, and then transfers to your family without him taking a cut at the door. But it is a genuine insurance product with real costs, commissions, and fine print, and it is wrong for far more people than it is right for. So it is the one place here you never buy on your own, in a hurry, from whoever pitched it to you. It belongs at the end of a plan, not the start of one. Where it earns its place is for someone who has already filled the other accounts, who has more than they will ever spend, and who wants to hand a clean, tax-free sum to the next generation. In that narrow case, it moves money into a vault the taxman cannot open, in this life or the next. Now, no one uses all 5 of these at once, and you should not try to. The right mix depends entirely on where you stand. Someone still working leans on the Roth accounts and the health savings account, while the paychecks are still coming in. Someone already retired and sitting on taxable savings looks hardest at conversions and at municipal bonds. Someone whose main worry is leaving money cleanly to their children looks at the life insurance and the Roth, both of which pass to heirs with the taxman shut outside the door. The point is never to own every one of them. It is to know which of these doors is the right one for the money you actually have, and to walk through it before the window closes. Now, knowing the 5 places is only half the battle. The other half is actually getting your money into them before the partner starts collecting, and there are 2 moves that do it. The first move is a conversion, shifting money from a traditional account into a Roth so it can never be taxed or forced out again. The timing on it matters enormously, and it rewards people who move early rather than late, so it is worth sitting down with a professional to map out which years to do it in and how much. The second move is the one hardly anyone knows about, and it is pure gold for anyone already being forced to take money out. If you are 70 and a half or older, you can send money straight from your traditional IRA to a charity you believe in, up to a large annual limit that runs above $100,000. It is called a qualified charitable distribution, and here is why it is so powerful. The money never passes through your hands as income, so the IRS never taxes a dollar of it. It counts toward any amount you are required to withdraw that year, satisfying the rule. And because it never lands in your income, it also quietly lowers the very numbers that decide how much of your Social Security is taxed and how high your Medicare premium climbs. One move, and the partner walks away from 3 pockets at once.
And it is not limited to cash from an account. There is a close cousin to this move for the taxable investments you have held a long time. If you own stocks or funds that have grown for years, handing those shares directly to a charity rather than selling them first lets you skip the tax you would have owed on all that growth entirely. Either path follows the same quiet principle. Money that would have been dragged through the taxman's hands is steered so that it never touches them at all. And here is the part that turns all of this urgent. These moves run on a calendar, not on your schedule. A conversion and a charitable transfer each have to be completed by the last day of the year to count for that year. There is no filing an extension, no getting to it in the spring when you finally sit down with your taxes. The 31st of December is a hard wall. Miss it, and an entire year of shelter is simply gone, while the taxman keeps his claim marching forward the whole time. The real deadline was never some distant birthday. It is the end of whatever year you happen to be standing in right now. Now, a warning, because a fear this real is exactly what predators feed on. The same anxiety about the taxman coming for your savings is the lever a bad annuity salesman or a pushy insurance agent will pull to sell you a product stuffed with fees you do not need. And every move here carries a trade-off. A conversion means a tax bill in the year you do it. Life insurance carries real cost. So the smart step is to never act in a panic and never hand your money to whoever called you first. Sit down with a fee-only advisor or a tax professional, someone paid to serve you and not to sell to you, and build the plan on paper before a single dollar moves. But do not mistake that caution for permission to wait, because waiting is precisely what the partner is counting on. So look at the whole board one more time. On one side, money sitting in accounts the government still owns a piece of, waiting to be forced out and taxed. On the other side, 5 places: the Roth IRA, the Roth 401k, the health savings account, municipal bonds, and permanent life insurance, where that same money grows and, in most cases, comes out with the taxman locked outside the door. The IRS is never going to send you a letter explaining any of this. It does not profit from your understanding. It profits from your silence, your delay, and your belief that the money was all yours to begin with. The retirees who hold on to the most are almost never the ones who earned the most. They are the ones who moved their money onto the safe side of that line before the collecting ever started. The ones who do nothing simply keep holding the taxman's share for him, year after year, until he arrives to take far more of it than they ever pictured. Your savings were supposed to be the reward for a lifetime of work. Where you keep them now decides how much of that reward stays yours, and how much the silent partner walks away with. This is general information, not tax, legal, or investment advice. Retirement account rules, income limits, and the specific moves described here depend on your own age, income, and state, and they change over time. Before you convert, buy, or move anything, sit down with a qualified tax professional or a fee-only advisor and confirm exactly what fits your situation.